Hey everyone, welcome to the video. My name is Derek and I got my degree in finance, so you don't have to. Today we're talking everything related to the stock market. We're going to talk about the differences between stocks, ETFs, and mutual funds. We're going to talk about how you can make a return in the market with very little effort. We're then going to break down the different types of ETF funds, and then we're going to talk about what research says. And at the very end, we're going to talk about how someone with 10 years of experience who does have their degree in finance positions their money in the stock market, so you have a better understanding of how you should be investing safely to also make a return in 2023. Let's get right into it. Now, right off the bat, let's distinguish the difference between an ETF, an exchange traded fund, and a mutual fund, because there is a difference and it is significant. ETFs, on one hand, are usually passively managed. This means that an ETF usually tracks either a broad market like the SP 500, which is the largest 500 stocks in the US market, or it tracks a sector like the tech sector, right? Or like the value or dividend sector. Mutual funds are a little bit different. Mutual funds traditionally have been actively managed. That means that there is an active manager making buy and sell decisions for the fund. Traditionally, mutual funds also had a higher minimum deposit, whereas opposed to an ETF, which has a fixed price. You can buy one, you can buy 1,000. Here's the thing, mutual funds also tend to have a higher management fee because a manager has to be actively paid for his or her purchase decisions and his or her expertise. With that said, it has been proven time and time again that most of the time, a mutual fund will not outperform a general broad-based ETF. So for most investors, especially if you are getting started in investing or you want to take your investing more seriously, an ETF is the way to go. Now, with that said, it is also good to have a few different ETFs, some broad-based to protect against downward moves, or some specific or niche-based to take advantage of potential upside swings that are larger than the overall broad market. Remember that both mutual funds and exchange-traded funds are different and separate than individual stocks. An individual stock is you or I choosing and making a buy and sell decision just like a mutual fund manager would do, but doing it for our own account. So I can go into the market and I can buy Apple stock, I can buy Tesla stock, I can buy Netflix stock, and in a sense, I can create a miniature tech exchange traded fund for my own personal account. With that said, more skill is required in order to fundamentally evaluate a company and to see if that company is overvalued or undervalued. As Warren Buffett says, sometimes it's not smart to buy bad companies at an undervalued price. Sometimes it's much more smart to buy great companies at a fair price. In future videos, we will talk about fundamentally analyzing a company. I do have my degree in finance. I do want to stress that, and I want to share that information with you on how to fundamentally analyze a company. But for the sake of this video, for most people, an exchange traded fund or a group of exchange traded funds are an excellent way to go forward in investing in the market. They offer protection, they are less risky than picking individual stocks, and still over a long term, they can create some excellent returns. And that, my friends, brings us to the next part in this video, which is making a return in the market with little to no effort. So as you know, I'm a big proponent of being active or actively managing your stock portfolio. With that said, there can be something said about being able to make a return, especially if you are a busy individual with little to no effort. In order to make a return with little to no effort, you must focus on broad-based ETFs and sector-based ETFs, and you need to maybe step away from individual stocks. I'll explain why. Individual stocks are hand over fist more risky and more volatile than a broad-based ETF or a specific niche-based ETF. This has to do with something known as beta. Beta is the overall volatility compared to the general S&P 500. Lots of individual stocks tend to have a higher beta than the S&P 500, especially growth stocks. The Apples, the Netflix, the Amazon of our day and age. While these growth stocks can produce extreme returns, they can also produce extreme losses. Take Tesla, for instance. From 2010 to about 2019, Tesla grew at an incredible rate. Then 2019 through 2021, it absolutely skyrocketed. Like, it turned on its turbocharger and it exploded in value. With that said, 2022 now into 2023, Tesla has lost a huge amount of that earned value. Basically, individual stocks, especially high beta stocks, can make or break your portfolio. If you are trying to make a consistent return with little to no effort, these violent swings can be detrimental to your portfolio. Don't get me wrong, I am a huge believer in actively managing your portfolio, but for this instance, with a tech-specific ETF like, for example, VGT, you can still have exposure to Tesla, as well as Amazon, Netflix, Apple, without the beta being too much higher than the general market, which means in times like this, while VGT has definitely come down in 2022 and 2023, it has not nearly come down as much as individual tech stocks. Not only that, with a broad-based or a niche-based ETF, you are protected against one or two of those stocks exploding or going bankrupt. In a worst case scenario, if you have 2 or 3 stocks and they're all correlated, say they are all tech stocks, if something goes wrong with those 2 or 3 stocks, maybe they go bankrupt, maybe economic headwinds cause major trouble to those 2 or 3 stocks, your portfolio would see a massive decrease in value. Whereas a well-balanced portfolio with a significant portion of its money invested in a tech ETF like VGT is protected because it is a bundle of stocks, not just 1, 2, or 3 stocks that make up or comprise the individual ETF. After the Where to Invest Your Money in 2023 series, we are going to talk more in depth about the different ETFs. We'll talk about VOO, we'll talk about VGT, and we'll talk about many others that can comprise a well-balanced portfolio. If that's something that interests you, please feel free to hit the subscribe button, turn on the bell notification so you'll know when we drop the next video. Okay, now let's talk about broad-based ETFs. These are the ETFs that should make the bulk of most people's portfolios because they track the overall market. Most of the time when we are talking about the overall market, or when you hear someone talk about the stock market, they are talking about the S&P 500. The S&P 500, or the Standard & Poor's Index, is the 500 largest companies in the United States stock market. When you hear that the market went up today or the market went down today, most people are talking about the S&P 500 as well as the Dow Jones Industrial Average. I'm going to use VOO as an example, although there are many variations of an index tracking fund. VOO tracks the S&P 500 and it tries to balance the fund in a way that exactly or very closely represents the S&P 500. That means that when the S&P 500 goes up, the VOO also goes up. When the S&P 500 comes down, the VOO also comes down to a near equal amount. When we look at historical returns over the last 50 years in the stock market, you can see that year over year, the stock market, the S&P 500, tends to return 8 to 10% per year based on who's doing the estimate. For most people who want to make a return with little to no effort, these returns are more than plenty to make you a millionaire in a couple of decades. Now, wait. Before you say, oh, I don't want to be a millionaire in a couple of decades, I want to be a millionaire today. I understand that. And that will take actively managing your investments. But for passively managing with little to no effort, just remember, a decade will pass, 2 decades will pass, and you can either be a millionaire or not. So make sure to remember that time passes whether you take action or not. Always take action and plan for your future. So when it comes to investing in stocks in 2023, ETFs should make the bulk or the majority of your portfolio. Reason being is because they are safer. And if we are trying to make a return with little to no effort, they are the types of assets that you want to have in your portfolio. Now, when it comes to broad-based versus sector-specific ETFs, a good balance is usually recommended. This also depends on your age. The younger that you are, the more risky you can be because the more time you have until retirement. This means that you have more time to make up for the losses that can take place at any moment. Take 2022, for example. What about individual stocks? I believe that if you have the ability to analyze individual stocks the right way, which we will be releasing a video, so please hit that subscribe button so you don't miss that, you can have individual stocks in your portfolio. But any individual stock, in my opinion, should not take up more than 5, at the most, if you are young and you are a risky player, 10% of your portfolio. This number is still high enough that you will experience extreme returns if your conviction turns out to be true, but it is also not large enough to completely destroy your portfolio in a worst case scenario. So a balanced stock portfolio, which fits inside an overall portfolio of stocks, bonds, and potentially real estate, has a majority broad-based ETF funds with some sector-specific funds like tech, value, or dividends, with a few strong conviction stocks. Remember that when we talk about a stock portfolio, that is in essence a portfolio inside of a portfolio. Your general portfolio should have stock allocation, bond allocation, speculative asset allocation, real estate allocation, and alternative investment allocations like wine, like fine art, etc. And in some cases, anti-inflation investments like gold and silver. Now, in regards to investing in 2023, what does research say? Well, the main concern is recession. And even avoiding recession, people like David Kostin from Goldman Sachs believes that equities are going nowhere for the rest of the year. According to Goldman Sachs, this is because a soft landing is already priced into the stock market. A soft landing is where federal monetary policy is able to combat inflation without causing a recession. So even avoiding a recession, it looks like there is a chance that equities don't go anywhere up or down for the rest of the year because earnings may not increase very much for 2023. Remember, fundamentally, earnings are what drives stock prices up or down. A company has to be profitable in order for the stock price to go up, at least usually, when the market isn't crazy. But what about years-long research and data? Well, that paints a prettier picture for investing in equities in 2023. On average, for the regular investor who wants to make a return, the best policy is to not try and time the market, but to invest every single year, preferably on a monthly basis, because if you have time on your side, as long as a meteor doesn't come in and absolutely destroy the world, you will make a return based on the last 50 to 100 years worth of data. So we're in a weird place right now. I understand that. We still have supply chain issues. We still have recession potentially looming. With that said, investing is still a very important and vital part to your financial future, and you should not try and wait or time the market. You should be investing in broad-based and sector-specific ETFs to be able to capture some of that growth in the future. Another thing, when you look at the stock market from a technical perspective, this means analyzing charts, which is something I'm very fond of, and I do believe provides insight when done correctly. The stock market looks to have put in a bottom, and it looks like severe lower lows may not be in the cards anymore as long as we can avoid a major recession. So then, how am I investing my money in 2023? Well, first we need to define what we are talking about. We are talking about my long-term portfolio in stocks in specifics. What I've done for a long time and what I will continue to do is to dollar cost average my positions. What is dollar cost averaging? Dollar cost averaging basically means to continue to invest even though an asset's price is moving down. This dollar cost averages your entry price because as the asset moves down, as you continue to put money into it, your entry price or your break-even price continues to lower. This is a terrible strategy in trading or short-term investing, but it is an excellent strategy in long-term investing where you have time on your side and you are investing in fundamentally sound assets. That means maybe not cryptocurrency or coins. That does mean the S&P 500 ETFs as well as strong sector-specific ETFs. I am also changing my portfolio structure a bit. While I have heavily focused usually on tech stocks when it comes to my sector-specific ETFs, I am taking to heart the advice of people much smarter than me, like Peter Schiff, who believes that value plays and dividend plays are what's going to make money in 2023 and beyond. Some good dividend ETF plays are, for example, ProShares Dividend Aristocrats, ticker symbol Noble, which I've had in my portfolio for quite some time. I will continue to add. If you like Vanguard, a good one is VIG, which is their Dividend Appreciation ETF. And if you're after low volatility, Invesco makes a good one. Its ticker symbol is SPHD. So the main takeaways of this video is that if you want to make money in the stock market with little to no effort, your best bet are ETFs, both broad-based as well as sector-based ETFs. If you want to make more money than that in a shorter amount of time, then an active investing approach needs to take place. And I want to remind you, we will have a video covering exactly how to fundamentally analyze a company very soon. Please feel free to hit that subscribe button, turn on the bell notification, so when that video comes out, you're alerted and you are informed. Again, my name is Derek. Finance and investing have been my absolute passions since college. I've been in this industry for close to a decade. I've also been an entrepreneur for over 10 years. So if you want to learn from someone who's done it and someone who loves teaching and sharing with others, please feel free to follow along. It is my personal goal to put out good quality content that is also fun, because if you cannot have fun, you will not learn. So it is my goal to do those things, and I can't wait to share this journey with all of you. I hope you took something out of this video, and I hope you learned something to better be prepared for investing in 2023. Remember, this is one video of a series of videos. We're also going to cover investing in real estate, investing in cryptocurrency, investing in bonds, and investing in high yield savings accounts in 2023, and how you should position your money to take advantage of all these opportunities, because no matter the time, no matter the market environment, there is always opportunity if you open your eyes and you look. I will see you in the next video.